Welcome back to Investing Talk Podcast.
Today we're focusing on SoFi Technologies and its upcoming earnings to watch.
This is definitely a big one. Before we get into what to look for, be sure to subscribe, like, and comment to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, so let's break down the key things we'll be watching for in this report. Because for SoFi, this Q3 2025 earnings report, it's expected Monday, October 27th, 8:00 a.m. Eastern. And it's shaping up to be, well, pretty contentious, actually, more than we've seen in a while. What really jumps out is just how much disagreement there is among the analysts.
Yeah, that conflict seems to be the real heart of the risk here. It feels like analysts aren't just quibbling over revenue. They're fundamentally disagreeing on the cost side, right?
Yeah.
The range of estimates is just huge. And that's definitely driving up potential volatility. So what are these competing numbers?
Okay, so we're looking at two pretty different worlds here. On one hand, you've got Zacks, they just reported, projecting earnings per share of $0.08.
8 cents?
No. Yeah, ambitious, right. That's a 60% year-over-year jump. And they see revenue quite high, too, at $886.23 million.
Okay, but then you look at FactSet, and they're significantly lower, especially on earnings. They're projecting revenue around $862 million, which isn't that far off Zacks, relatively speaking. But their non-GAAP EPS is only 0.03 cents. 3 cents versus 8. That's a massive gap.
It is. And that gap tells you the fight is really about efficiency. Both sides seem to agree SoFi's getting the members, getting the products out there. The revenue numbers are close enough, but the EPS difference, that means a huge disagreement on, how much it costs to get those members, how much they're setting aside for loan losses, the provisioning, and ultimately what the real margin is on that fast-growing financial services side.
Right. And then there's this sort of market psychology piece, the whisper number.
Yeah.
What are traders actually betting on? Sources show that's sitting right in the middle, around 0.05.
Exactly. So even if they hit 4 cents, which beats FactSet, the street might still feel let down if they were whispering 5.
Which makes the company's own guidance even more critical as an anchor. What did they say?
They guided for Q3 revenue between $850 and $870 million. So both FactSet and Zacks are kind of within or just above that range. And crucially, management has really stuck to their guns on the full year outlook for net positive GAAP earnings.
Okay, so they need to show they're hitting their own plan for profitable growth. What about recent estimate revisions? Because those often signal short-term price moves.
Yeah, and it's another one of those mixed signals you often see. Over the last month, the consensus EPS estimate actually ticked down slightly, about 0.7%.
Okay, so some nervousness on margins maybe, inflation, acquisition costs.
Could be, but the revenue estimates have actually been revised up recently, about $8 million higher over the last month.
So the street believes the sales are coming in. They're just not sure how much profit drops to the bottom line.
Precisely. Which leads us right into that core growth story scaling the platform. So obviously, it isn't just loans anymore, it's this whole financial ecosystem.
Right. And for that, the number one metric has always been member growth. You need the users.
Absolutely. Have to see that the cost of getting the bank charter and building all these products is actually paying off in new signups. And the projections there look pretty solid. Analysts are looking for total members to hit 12.52 million.
12.5 million. And what was it last year?
9.37 million in the same quarter last year. So a really big jump.
Okay, big jump in members. But are they using the platform? It's not just about the count. It's engagement, right? Using multiple products.
It looks like it. The total products metric, so loans, checking, investing, whatever, is expected to hit 18.53 million.
Up from
13.65 million year over year. So that supports the cross-selling story they keep telling.
And that cross-selling, that engagement, it all feeds into the segment everyone's really watching closely, financial services. This is the part that proves they're more than just a lender.
That's the one.
Right.
This segment includes things like SoFi Money, SoFi Invest. Projections show it holding about 15.67 million products. But here's the headline number. Analysts are forecasting massive revenue growth here, like a stunning 57.4% year-over-year increase.
57%. Wow.
Yeah, expected to bring in $375.01 million in revenue just from that segment.
Okay, that number, that 57%, feels like the whole thesis in a nutshell. If they miss that significantly, the whole narrative kind of wobbles, doesn't it? Suggests the bank transition isn't happening fast enough to justify things.
I think that's fair. So, okay, let's peek under the hood a bit. How are they actually making money from all this activity? Two main streams, right?
Yeah, you've got your lending income and your fee income, essentially.
Starting with lending, that's net interest income, NII, basically the spread between what they earn on loans and pay on deposits. NII is projected at $545.29 million. That's up a healthy 26.5% year over year.
Okay, solid growth there, shows the bank charter is working. What about the other side? Non-interest income, fees and services.
Right, that's everything else. Projected at $343.62 million, and that's actually growing a bit faster than NII, 29.1% year over year.
Which suggests they are successfully monetizing beyond just lending spreads. Good mix.
Definitely shows the ecosystem is contributing.
And we shouldn't forget the sort of quiet achiever here, the technology platform segment. Galileo and Technisys, that's their B2B side, selling banking infrastructure.
Yeah, pure diversification, and important. That revenue stream is projected to grow about 12.6%. Slower, but steady.
Hitting about $115.47 million. So, not the explosive growth of financial services, but it's high-margin, stable B2B income, proof they aren't just a consumer lender.
Exactly. Now, even with all that growth, we do need to talk about potential headwinds. Q3 can be seasonally weak for lending.
Yeah, especially after the main student loan season wraps up.
And you see that directly in the forecast for their original business. Revenue from loan originations, sales, and securitizations. That's actually projected to fall by 4.4% year over year.
Oof. A year-over-year decline, even if seasonal, isn't a great look.
Comes in at about $67.04 million.
Which just highlights again why that massive 57% growth in financial services isn't just nice to have, it's absolutely required to offset this lending softness.
Totally. It has to pull the weight this quarter. And, another thing investors always watch, even if analyst sentiment is generally okay, is insider activity. We did see some executive selling noted in the SEC filings during the quarter, the EVP and the CTO specifically.
Doesn't automatically mean trouble. Executives sell for lots of reasons, but it's a data point. A yellow flag, maybe, especially with ambitious targets out there.
Right. But let's balance that. There were also some genuinely positive catalysts during the quarter, things the company did.
Sure. What stood out?
Well, they expanded SoFi Invest into level 1 options trading. That potentially makes the platform stickier for more active traders.
Okay, adds functionality.
And the partnership with Stripe for instant fund withdrawals. That's a big user experience win. Getting money faster is always good in consumer finance.
Definitely. And what about institutional money? Are the big firms buying in?
Seems like it. Sources mention firms like Katong International increasing their stakes. And the overall street guidance for the full-year EPS is still pretty bullish, around 0 and 31 cents. Suggests longer-term confidence.
And then there's the big macro picture, interest rates. That's always looming over SoFi.
Hugely important. The stock popped before on signs of softer inflation. Why? Because everyone knows that if the Fed eventually starts cutting rates, that's a massive tailwind for SoFi.
Right. Boosts loan demand, lowers their own funding costs. It's a double win.
So you got all these pieces. Conflicting analyst views, huge growth targets, seasonality, macro factors. It makes for a high-stakes report.
And historically, the stock moves big on earnings, doesn't it?
Oh, yeah. Very volatile. Saw a 3.7% pop the day after Q2 results. And remember, Q4 last year jumped over 7% the week after. That kind of volatility is expected.
And the stock's been kind of stuck lately, right? In a range.
Yeah, pretty tight between about $8.50 and $9.60. Seems like it's coiling for a move.
So what's the options market pricing in? What's the expected move this time?
Based on the current implied volatility, the market's bracing for a move of about plus or minus 0.75 cents after the report comes out.
75 cents. On an $8-9 stock, that's nearly a 8-9% move. That's significant.
It tells you the market believes this report could either really validate the high growth story or seriously disappoint on the profit efficiency side. Big swing potential.
Okay, so let's try to tie this together for you, the listener. Boiling down the sources, what are the two likely scenarios? The bull case seems to hinge completely on margin expansion. They need to show they're scaling efficiently, spending wisely to get those members. And critically, that financial services growth number, that 57.4%, they probably need to beat that.
Right. The bear case is the flip side. Margin compression. Costs running too high to get those 12.5 million members. Or maybe unexpected deeper weakness in student lending more than just seasonality. The two things to watch above all else. Member growth. Gotta hit that number. And decisively, that financial services revenue mix realizing its huge target.
It really does feel like it comes down to execution versus the very specific guidance they've laid out.
Yeah, the overall lean feels neutral to slightly bullish heading in, mostly because of that sustained member growth and the diversification story. But the real test, I think, is whether that explosive financial services growth really does offset the expected lending softness. And maybe even more importantly, does management feel confident enough about margins to actually raise the bar on their full year guidance? That will be a strong signal.